What if I told you that the biggest move in silver is not behind us, but still ahead of us? What if the recent crash, the volatility, and the confusion in the market are actually part of a much bigger setup? Right now, most people are either scared or confused about silver. Some think the rally is over, others think it was just hype. But smart money is looking at this very differently. They understand something important, and if you understand it too, it can completely change how you see this market. Welcome to Gold Silver Scope, where we break down complex gold and silver trends into simple insights so you can stay ahead. Let's start with something very important. Every major bull market follows a pattern. It does not move straight up, it moves in phases. And the first phase is what we call the stealth phase. This is the phase where almost nobody is paying attention. Prices move slowly. There is no hype, no excitement, just quiet accumulation by smart investors who understand what is coming. And this is exactly what we saw in silver over the last couple of years. From around late 2023 into early 2024, silver was slowly building strength. There was no big news, no major headlines. But underneath the surface, something was changing. Smart money was buying. They were patient. They were accumulating while prices were still low and stable. And then something incredible happened. It took silver decades to recover from its old highs. It took around 45 years to reach a major level again. But once it broke out, it moved extremely fast. In just a few months, the price doubled. This tells you something very important. When a market is ready, it does not move slowly. It moves aggressively. But here's where most people get confused. After a big move, markets do not keep going straight up. They need to pause. They need to correct. They need to reset. And that's exactly what happened in silver. After a very strong rally, the price corrected sharply. This scared a lot of people. Many who bought late during the hype started to panic. But in reality, this correction was completely normal. If you look at past bull markets, silver has always gone through deep corrections. In previous cycles, it had multiple corrections of 20%, 30%, even close to 40%. These corrections are not a sign of weakness. They are part of the process. They shake out weak hands and prepare the market for the next move. And that is exactly what we are seeing right now. After the big rally, silver dropped quickly. Then it bounced. Then it corrected again. This kind of volatility creates confusion. Some people think the trend is over. Others don't know what to do. But experienced investors understand this pattern. They know that after the stealth phase comes the next phase, the awareness phase. And this is where things start to get interesting. Now we are entering the second phase of a bull market, and this is called the awareness phase. This is the stage where more people start noticing what is happening, but the market is still not fully understood. Prices are more active, volatility increases, and emotions start to play a much bigger role. In this phase, something very important usually happens. It is called a bear trap. A bear trap is when the market rises very fast, pulling in a large number of new buyers. People start feeling excited. They think the price will keep going up forever. This feeling is called FOMO, fear of missing out. So they enter the market late, often near the top of a short-term move. And then the correction happens. Prices fall quickly, and those same people who bought late suddenly feel trapped. They see their profits disappear or turn into losses. This creates fear. Many of them exit the market, thinking the move is over. But in reality, this is exactly what the market wants to do. It shakes out weak hands before the next move begins. We saw this clearly in silver recently. After a strong and fast rally, silver reached very high levels. It even touched extreme intraday prices that many people were not expecting. At that point, excitement was at its peak. People were talking about higher and higher targets. But very quickly, the market reversed. The correction came fast and hard. In a short period of time, silver dropped significantly from its highs. This shocked many traders. Some believed the bull market was finished. Others said it would never recover. But experienced investors saw something different. They saw a classic bear trap forming. Because after the drop, something interesting happened. Silver did not collapse further. Instead, it stabilized. It started to recover in waves. Prices moved up and down, creating a sideways pattern. This is a very important stage in market cycles. It is called consolidation. During consolidation, the market is not trending strongly in either direction. Instead, it is building energy. It is allowing emotions to reset. Fear starts to fade, and slowly, confidence begins to return. But this process takes time. These corrections and sideways movements can last weeks or even months, and during this time, many people lose patience. They leave the market. They assume nothing is happening. But underneath the surface, a stronger foundation is being built. This is why understanding psychology is so important in markets like silver. Because silver is not just driven by numbers, it is driven by emotion. Fear during corrections, excitement during rallies, confusion during sideways movement. And this constant emotional cycle creates opportunities for those who can stay calm. Right now, silver is in that uncertain phase where opinions are divided. Some see weakness. Others see opportunity. But history shows that these are often the best times to pay attention, because major moves do not start when everyone agrees. They start when most people are confused. And that is exactly the kind of environment we are seeing now. Now let's move deeper into one of the most important reasons behind silver's long-term strength. And this is something many people still underestimate. It is the supply side of the market. Because no matter how strong demand becomes, if supply is limited, prices eventually have to adjust. And in silver, the supply situation is becoming increasingly tight. For many years, silver had a hidden advantage in the market. There were large, above-ground inventories available. These stockpiles acted like a buffer. Industrial users could simply buy silver from these existing reserves instead of putting pressure on new mining supply. This kept prices relatively stable for a long time. But that situation is now changing. Those inventories have been gradually shrinking. Year after year, more silver has been consumed than has been replaced. Mining production has not increased significantly, and recycling only adds a small portion of new supply. This creates a structural imbalance in the market. This imbalance is called a structural deficit. A structural deficit means that demand is consistently higher than supply. And when this happens over multiple years, the market slowly tightens. At first, it is not obvious. Prices may not move much, but eventually, the shortage becomes impossible to ignore. And that is where pricing pressure begins. Another very important factor is the role of industrial demand. Silver is not just a precious metal, it is also an essential industrial metal. It is used in electronics, solar panels, medical devices, and many modern technologies. This means demand is not optional, it is necessary. And here is the key shift. Industrial demand is now a much larger share of the total silver market than it was in the past. This means more silver is being permanently consumed every year. Once it is used in products, it does not easily return to the market. At the same time, investment demand can return very quickly when sentiment changes. This creates a powerful combination. When industrial demand stays strong and investment demand rises at the same time, it creates a supply squeeze. And that is exactly what makes silver different from many other assets. Because unlike financial assets that can be created in unlimited quantities, silver depends on physical production. And that production cannot easily adjust to sudden spikes in demand. Mines take years to develop. Recycling cannot scale instantly. And inventories are already lower than before. This means the market becomes very sensitive. Even small changes in demand can have a big impact on price when supply is tight. And this is why silver often moves sharply once momentum begins. It is not just speculation. It is a reaction to real physical constraints in the system. There is also another important point. When supply becomes tight, even large buyers can struggle to secure enough metal. This creates additional pressure in the market. It forces prices to adjust to attract new supply or reduce demand. And historically, this is the stage where silver starts to behave differently. Because once structural deficits become widely recognized, the market begins to reprice the metal. It moves from being seen as abundant to being seen as limited. And that perception shift is extremely powerful. Right now, all of these conditions are slowly building in the background. Supply is tight, demand is steady, industrial usage is strong, and investment interest can return at any moment. This combination creates the foundation for long-term upward pressure. And this is why many analysts believe that silver is entering a critical phase in its cycle. Not because of short-term hype, but because of long-term supply reality. Now let's connect everything to the bigger market picture and understand what it actually means for the next phase of silver's move. Because when you look at price action alone, you only see part of the story. But when you combine price behavior with supply conditions and investor psychology, the full picture becomes much clearer. Right now, silver is in a phase where volatility is high, but that is not a negative sign. In fact, in strong bull markets, volatility is completely normal. Prices do not move in a straight line. They move in waves. Strong rallies are often followed by sharp corrections, and then consolidation phases where the market rests before the next move begins. This is exactly what we are seeing today. After the recent strong moves, silver went through a sharp correction. Many short-term traders got shaken out. Sentiment turned negative for a while. But instead of collapsing further, the market stabilized and started building a base again. This type of behavior is very important because it shows underlying strength. Weak markets do not recover quickly after a correction. Strong markets do. Now let's talk about an important relationship in the silver market, and that is the connection between silver prices and mining companies. When silver moves, mining stocks often react even more strongly. But this reaction does not always happen immediately. Sometimes miners lag behind the metal itself. This creates opportunity. When silver is strong but miners are still undervalued, it often means the market has not fully priced in future profits. Because higher silver prices directly improve revenue and profit margins for producers. Even small increases in price can lead to large increases in earnings for mining companies. And historically, this is where some of the biggest gains happen. But it is important to understand that miners do not move in a straight line either. They are also affected by market sentiment, operational challenges, and broader equity market conditions. However, over time, when silver trends higher, mining companies tend to follow. Another important point is that the market often underestimates how quickly sentiment can change. When silver starts moving again after consolidation, investors who previously ignored it suddenly become interested. This creates a wave of new demand that can accelerate price movement. This is why accumulation phases are so important. They happen quietly, without much attention, but they set the foundation for the next major move. Right now, silver is in that type of environment where the market is not extremely bullish or extremely bearish. Instead, it is transitioning. And transitions are often the most important stages in any cycle because they decide what comes next. Either the market continues to consolidate for a while longer, building more energy, or it starts the next upward phase as momentum returns. In both cases, the long-term structure remains strong as long as supply constraints and demand pressures stay in place. And based on current conditions, those fundamentals are still intact. This is why many experienced investors are not focusing on short-term price swings. Instead, They are watching the bigger trend. They understand that volatility is not the enemy. It is part of the process. And in many cases, it is what creates opportunity. Because when prices move quickly in both directions, emotional decisions increase. And emotional decisions often lead to mispricing in the market. That is where long-term investors step in. So even though the short-term picture may look uncertain, the broader structure continues to support the idea that silver is still in a larger bullish cycle. And that cycle is not finished yet. Now let's bring everything together and understand the final message of this analysis. When we look at silver from a bigger perspective, we can clearly see that the market is going through a powerful long-term cycle. There are short-term ups and downs, sharp corrections, and emotional reactions. But underneath all of that, the structure remains strong. We have already seen how sentiment shifts from excitement to fear and back again. We have also seen how supply is becoming tighter over time, while demand continues to stay strong from both industrial and investment sides. And when these conditions combine, they create a very important environment for long-term price movement. Silver is not just a short-term trading asset. It is part of a global system that depends on real physical supply and demand. That is why its moves often feel more intense compared to other markets. When it rises, it can rise fast. And when it corrects, it can also move sharply. This is why understanding the full cycle is so important, instead of reacting to short-term noise. At this stage, the most important thing for investors and viewers is patience and discipline. Markets often test emotions before making their real move. Many people get shaken out during corrections, while others enter too late during excitement. But those who understand the bigger structure are able to stay focused on the long-term trend. And right now, the long-term structure is still pointing toward a strong and developing cycle in silver. The foundation is being built through consolidation, supply tightening, and repeated demand pressure. These are the conditions that often appear before major moves in the market. So instead of reacting emotionally to every price swing, the smarter approach is to observe, analyze, and understand where the market is in its cycle. Because timing and patience often matter more than prediction. Now, before we end this analysis, if you are someone who is following gold and silver markets closely, and you want more deep insights like this, make sure you stay connected with this channel. Gold Silver Scope. Here we focus on real market structure, supply and demand analysis, and long-term precious metals trends in simple and clear language. If you found this breakdown helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you don't miss the next important update.